Welcome, everyone. It's Brent Thill at Jefferies. We want to welcome the Splunk team in, Jason Child, CFO, Tim Tully, CTO. Thank you, gentlemen, for joining us to talk about the story. Maybe if we can just start off between both of you just talking about this mega shift to the cloud. Obviously, given what's happened with COVID, we continue to hear this shift to ongoing digitization of information and the stand-up of all these cloud applications that are happening. Can you just talk a little bit about what you're seeing in current business trends and how long you expect this to last?
Tim, did you want to start?
Sorry. Yeah, my connection just broke up a little bit. Yeah, I think the shift to cloud for us is an obvious one. The customers are sort of demanding and taking us there. In my team, we sort of turned the ship of the entire product and engineering organization to being cloud first, to the point where all of our products are released to cloud first nowadays. That's a complete 180 from where we were just a couple of years ago. So it's a huge transformation for the company, and it's been multiple years that we've been on this journey, and a lot of that work of re-architecting Splunk for the cloud is finally coming to fruition. And in our customer base, folks are seeing that. They're really excited. They love a lot of our new products. They're going to the cloud, and we're there with them. Just in the last session we were in, I was telling some of the attendees that what I'm seeing in the customer base is a lot of folks are moving more towards a hybrid world, quite frankly, than being sort of discretely either on-prem or in the cloud. And, fortunately, Splunk is well positioned to live in that world. We have a stream processing solution called DSP that essentially enables that kind of architecture where you can have both on-prem and cloud presence and move data back and forth between both sides with processing in the middle. And that solution is a natural bridge to folks who want to buy our cloud SaaS solutions, right? Because they can move data from their data center and then fan it out into different formats, into different solutions that we have in the cloud.
And Jason, for you, just from a financial perspective and how you're looking at this in terms of how you're managing the financial aspects of the business along this, just talk to us about how that's going.
First of all, I'll just say that the work that Tim's done has actually been incredible, especially given the baby here in the background. Like, he is managing and juggling a lot, like we all are. So well done. Anyways, so in terms of the financial aspects, what I would say is, one of the things that was interesting is we actually were kind of holding back the cloud business until we started this year. We actually were comping our sales team at less than on-prem. And the reason why was there was just a lot of work to do to get the product feature set right. Also, a lot of work to work on improving the margins. I talked in the past about how there's a bunch of work on working on multi-cloud and multi-tenant, some of the elasticity work where we pulled out compute and storage. And so just a lot of technical work to be able to get really the product ready. And so then when we started this year, we're now actually, compensating the sales team for cloud equal to on-prem. And ultimately, customers, we feel are going to make whatever choice works best for them. So that timing seemed to work out really well because once COVID hit, it turned out that I think the ability to actually deploy cloud when you're not having to procure servers, you're not having to find the people to do the work and kind of corral all the different efforts that it takes. I'd say that difficulty combined with just the fact that the product was really ready has led to a significant acceleration in our cloud, to the point where I think last year we were at about 35%. This year, this last quarter we were at 53% of our software bookings in cloud, and we actually are now projecting to end the year at roughly 60%, a full 2 years faster in terms of reaching 60% of our business in cloud on a booking basis versus what we thought at the beginning of the year, 2 full years earlier. So we're going to hit it at the end of this year instead of the end of fiscal 23. Anyway, so those are the pieces that we've been managing, and so far we're very, very happy with the progress that we're making.
Yeah, good to see the progress. Tim, just to mention or go back on the cloud first. So from your perspective now, you're effectively at parity where it doesn't matter what the client takes, they can get the same feature set on-prem or in cloud. When do you think that hit parity from a product perspective?
I mean, we've always been at feature parity with what we call Splunk Cloud historically, because as you know, what we called Splunk Enterprise Cloud was our on-prem product running in the cloud. And so I think more specifically in terms of the new container-based multi-tenant cloud-native architecture, feature parity is there at the Splunk Enterprise level. Where there's still work to be done a bit is more in the application space, specifically around security and IT. But it's not a showstopper for folks necessarily to move over, right? I mean, it's hard to get to 100%, and oftentimes you don't actually want to be at 100% feature parity. You actually want to take that as a moment to pare back pieces of the past that you don't actually like. So being at 100% is actually not a goal, to be honest. Which I think you would hear from most software leaders is, you take this time to not do that and kill dead weight, right?
Yeah. Just on security, that's roughly half the company's revenue, I believe. Correct me if I'm wrong. It's been a huge catalyst for you. Many are asking kind of, what's next, what's left? How do we think about the evolution of the security business from here?
Yeah, we announced something called Mission Control, which is essentially our next generation cloud native SIEM, if you will. And what that is a single pane of glass that allows our security users to essentially see the totality of their security posture, but in the cloud, and with more advanced third-party integration for other solutions, right? And so what that is what I call internally the grand unification theorem of security for us, right? It's a brand new UI. It's built for people to consume in the SOC. It's not just a rendition of your security posture in a Splunk dashboard meant to be consumed by that security analyst who's sitting in the security operating center. And again, the key there is the ability to plug and play third-party solutions from other sort of niche aspects of security into that solution so that you have one single pane of glass. My perspective on security is it's sort of like a humongous spectrum of different frequencies of colors of a rainbow. And it's hard to cover every aspect of every single frequency. And so you need a tool like Mission Control that can actually pull all of these together into one UI. And that demand is coming very specifically from CISOs and leaders in the SOC. And that's what Mission Control is there to deliver. So you're going to see features on that added. You're going to do that next month, and we're going to push it very hard. There's other things that we have working in the lab in terms of security. I can't quite share it yet, but stay tuned. There's much more to the story in my mind.
Yeah, Brian, I would just add that if you use the kind of Gartner security total addressable market, I think we're in the kind of 2.5% kind of low single digit range. And if you look just at like SIEM and some of the sweet spots where we're at, there we're going to be higher. We're in maybe the high teens, but we're still there's still a ton of runway. And then with some of the new features that Tim mentioned, we feel like that also expands beyond just the current parts of security that we're addressing today. Helps us get to attack the rest of the security kind of total addressable market, which again we're in the kind of low single digit percentage.
That's great. A lot of questions about SignalFX and what that's going to add. There's a lot of attention on APM and that market and where you can be given the success of others like Dynatrace and others in the market. Can you just talk to us a little bit about the overall trajectory with SignalFX and then specifically in APM?
Yeah. So maybe about a year ago, we acquired SignalFX, and we bought another company called Omnition at the same time. Omnition, by far and away, was the best distributed traces solution I had ever seen. And we spent the first few months of those acquisitions really pulling them together. And we released that unified version in March of this year. Sort of next stage of that story was to have logs sitting together with metrics and traces. And we've been working on that for the last 6 months, as well as a brand new user interface to modernize it, make it more usable, easier to go back and forth between logs, metrics, and traces, and making it more accessible for a wider variety of users, not just like the super power developer user. So you're going to see a lot of news from us in the next month or so at our conference, where we're going to reveal a lot of that work coming to fruition, where logs, metrics, and traces are together with that new UI, as well as some other interesting announcements in the space of observability. I prefer to use the word observability as opposed to APM, because APM tends to narrow you down into aspects of observability in my mind.
Okay. There have been a ton of questions just in the last 2 weeks, and this wasn't in the script, but just talking about, the new coming IPOs of Snowflake and Sumo. And I'm just curious if you can talk to, architecturally, there's some questions about can one vendor take on another vendor's market or whatever, but where do you see kind of where Snowflake and Sumo sit relative to where you guys are at?
Well, I see Snowflake more on sort of like the traditional data warehousing buyer, right? They want some kind of OLAP style of solution. I see some OLTP usage as well, to be honest. But it's they're playing in a slightly different world than Splunk, right? We live more in the unstructured world of log aggregation and log collection. Snowflake is much more in the structured world, so it's a different buyer. So I would call it more complementary to Splunk than anything else. In terms of Sumo, it's a different solution, slightly in a different space, right? It's more for SMBs in my mind, a little bit more down market. We tend to do much more up market where people have larger concerns around scale and being able to have long-term storage durability and being able to write queries that span years, right? So it's a little bit in a different segment.
Jason, the adoption of infrastructure-based pricing, that was a big move that you guys pivoted to. Maybe just talk. I think you mentioned in the last call this is going to take a while to roll out as new existing customers come back to you. But what have you seen so far? It seems like at least the checks we've had have been very positive, and it seems like the Salesforce and the partner ecosystem is starting to embrace this. What are you seeing from your lens?
Yeah, I'd say so far it's a relatively small portion of our customer base has moved to the infrastructure-based or workload-based pricing. But the customers that have increased volume, increased the amount of data that they're putting into Splunk, and that's exactly what we're hoping to drive with the pricing. We talked about a big customer win on the second quarter call, and we talked about how the way customers have, if you do heavy querying, then under the old ingestion-based model, you could really pay a lot, and it's hard to predict, and that's what we're trying to remove. So what we're doing is giving customers the choice to say, if you want to buy on the existing ingestion-based pricing, that's great. We'll also offer you a workload-based pricing alternative, which is going to be either virtual core for cloud, or it's going to be vCPU, virtual CPU for on-prem. And we'll let you make the choice. And what we found is that just by giving our customers the choice, I think that already is really helping them to understand the cost drivers. And then for the folks that really just don't like ingestion-based pricing, they find it hard to predict or hard to budget, and they're more, a lot of those folks are using more workload-based. They're really happy with it. And then some customers actually have stuck with the old pricing, but they feel better about it because now they have a choice. I think overall what I would say is, because we have customers, we don't have, kind of self-serve customers. All of our customers are negotiated via sales team through, contracts that are multi-year duration on average, usually 2.5 to 3 years. So what that means is you're not going to see the new pricing unless you're coming up for renewal. So we're about a year into the new pricing. So it's probably going to take us another 1.5 to 2 years before the full customer base sees it. And so that's why the adoption so far is relatively low. But we really liked the customer reaction thus far, and really feel very happy with the kind of the progress and the momentum that we're seeing.
There was questions around the Splunk Cloud and separating compute versus storage, and talking about how you can do that. How far along are you in that journey? You obviously want everyone to store their data there, but maybe they don't want to get completely charged. How are you handling that?
Well, I mean, that's a journey we've been on for quite some time. In fact, some of the architecture work for that actually predates even my arrival at Splunk, right? The sort of first leg of that story was it materialized as something called Smart Store, which is a feature that essentially lets you move colder Splunk buckets to blob storage in the cloud, and then essentially page it in and out on demand depending on workload. What we've done is really extend that story much more deeply, I should say, into fully cloud native, container-based Kubernetes deployments, all driven sort of the way you would imagine through Terraform, and it uses, things like Istio and Envoy and all these things underneath the hood. What we've done is really come to a point where this thing is fully operational. It's being already used within aspects of our observability solution inside the mission control, which I just spoke about a minute ago on the security side. And you're going to see this thing really power our traditional Splunk enterprise cloud users moving forward. That some of these new customers that will come on board will move to that first, and that's just right around the corner. And stay tuned at our conference again next month to learn more. Because we'll basically double click on the architecture, talk about timelines and when people will start adopting.
I would say just to apply the numbers to it, that was the driver. What Tim talked about is the driver of why I think our margins were very, very low a couple of years ago. Even 2 years ago, they were in the 30-ish% range. Then last year it came into the 50s. Now we're just approaching 60. The goal, you told folks we'll be above 60 in the low 60s by the end of this year. Expect to be approaching 70% end of next year. And all of the work that Tim just mentioned is certainly core to actually be able to drive those improvements.
New baby and a lot of architectural work. Congrats. That's a lot.
Yeah. He's actually yelling downstairs, so I'm having a little problem hearing you sometimes.
Jason, just when you think about the overall environment, we obviously went to, air brakes came on. No one knew what was happening. You've heard kind of this continual improvement. I think you guys called out, it was a good quarter, but it's still tough out there. But when you think about kind of your plans and hiring and adding direct quota carrying reps and going kind of trying to get back to normal, how do you think about this year and what changes you made around hiring and go-to-market resources? How has that shifted through the year for you?
So it's been a tricky year for us because we're not just dealing with COVID, we're also dealing with a pretty significant transformation where, the sales motion for cloud is different than it is for on-prem. And actually the good news is it's actually it's a tighter sales cycle because you're now selling a hosted solution. You're not having to deal with multiple folks in an entity that, you have to deal with procuring hardware. There's probably some headcount required as well as the actual license. And so that's great news. I would say that said, COVID is certainly, it's certainly made predictability of what really, for us, we have to predict what our customers are predicting. And, there's just a lot of uncertainty out there. And while, I know a lot of folks and some other companies have started, been very positive about macro. I think most of the companies I've seen that have been positive have also removed all their guidance, took it down, and then now taken it back up to some extent, but not quite to where they started. We're kind of one of the few that actually has maintained our ARR guidance throughout the year. And so from our perspective, we're continuing to hire DQCs. We're having to, we're growing, we grew 50% ARR last quarter. I think it's 6 or 7 quarters in a row over 50%. And so it's just, that with that kind of growth, we have to be continuing to invest in sales capacity. Cause again, we're not a self-service model. We're the sales team drives all of the growth. And then also now with cloud growth accelerating, last quarter from 82 to 89%. Now we're, well, between 400 million to $1 billion. I think we're the fastest growing cloud company on an ARR basis out there. And so that means we also have to continue to staff up for capacity. And obviously we gave out a 3-year CAGR that says we expect to maintain a 40% compounded annual growth from last year through FY23. And we haven't changed that guidance. So we're definitely going to continue to be hiring. And then of course, we're also making investments in Tim's team. We've made a lot of tuck-in acquisitions, to continue to evolve our platform to be really the best next gen platform to handle, massive data sets for security, IT, and observability. And those investments we're going to continue to make because of the growth trajectory we've seen and continue to forecast through FY23.
Tim, are there any verticals where you're like, wow, this could be pretty big, but we're seeing kind of minor adoption today? Is there any ones that kind of stand out to you? Again, I'm making this up, whether it's healthcare or government, or are there any big ones where you're like, wow, we're kind of just hitting the tip of the iceberg here?
Yeah, there are. I can't tell you. There's like major ones for sure that are, I think we have the raw ingredients for. We just sort of have to pull the trigger. That being said, I think there's a lot of growth still remaining in the observability, security, and IT ops front. We can go much bigger and much more broad than we have. And I think over time you'll see a little bit of both. But I don't want to get into what's the next big vertical for us. That being said, they're readily apparent in my mind.
Okay. And Jason, maybe last question. The true north of $1 billion cash flow. I think you are pretty clear. You feel confident that you can get there. Maybe just walk us through the things that you're seeing that are giving you that level of confidence.
It's relatively simple, and that is, as we continue to grow ARR, we will produce, roughly 20-ish% of ARR will become operating cash flow. And that is a cash yield that I think 2013 to 18, we were between 20 and 24% every year. So, as we kind of move through the transformation and now actually start to get all 3 layers, when we have a 3-year deals and we charge up front just for 1 year at a time, it's going to take us until middle of FY22 until we start to get the full, all 3 layers of the cash inflow finally coming back. We made this change last year. Next year, you'll see us turn positive middle of next year. And then, when you take your ARR projections times the, roughly-ish 20-ish% plus or minus, that puts you right in that $1 billion range. And if you were to look at our operating margin on an ARR basis, it would tie also pretty close to that percentage. And so that's how you get that's from a numeric standpoint, that's how you get there.
Great. Thanks for joining. Always great to have both you guys with us. So thanks for all your time and helping educate investors on the story.
Thank you, Brent.
Thank you.